I'd like to thank the C100 for the invitation. The C100's focus on stronger relations between the U.S. and China is a very constructive context within which to discuss the topical issue of sovereign wealth funds. The first thought that I would offer, though, is that the sovereign wealth fund issue is, of course, much broader than just China. Sometimes one hears that the United States only became interested in sovereign wealth funds when China decided to form one in January 2007. I can bring a bit of personal insight here since I've been involved in the Treasury's work on sovereign wealth funds from the very start. A Treasury team started looking at sovereign wealth funds, the issues they raise, and a potential policy framework in the second half of 2006, several months before we even heard that China itself was interested in creating one of its own. So if it's not just about China, what is it about? Well, at Treasury, it's essentially about a structural shift in the global economy toward higher cross-border government-controlled asset holdings. And to simplify, let's just focus on international reserves and sovereign wealth fund assets. Reserves, which are very conservatively invested in industrialized country government bonds, are now about $7 trillion. Sovereign wealth fund assets, which are invested in a more diversified, higher risk-return manner, total about $2 to $3 trillion. The International Monetary Fund projects that due to transfers from foreign exchange reserves and continued high commodity prices, sovereign wealth fund assets will reach 6 to 10 trillion by 2013. Well, how big is 6 to 10 trillion? Well, the answer is that it depends on the metric. There are ways to make sovereign wealth fund assets seem very large. Hedge funds manage only $1.5 to $2 trillion unleveraged. And the market capitalization of the S&P 500 is roughly $12 trillion. But there are also ways to make sovereign wealth fund assets seem small. They're just a fraction of the approximately 190 trillion in global financial assets. But clearly, sovereign wealth funds have already attained systemic significance. So this is a significant shift. And if you're sitting in Washington, it's only responsible public policy to think through the implications of the shift. But the essential challenge for policymakers in all countries is to address those implications in a sensible, rational way without resorting to protectionism. It's critical to stress here that the United States economy benefits tremendously from foreign investment. Foreign investment deepens our capital markets, it creates good jobs, spurs innovation, improves productivity, and results in lower prices and greater variety for consumers. So against that backdrop, what are the implications of the increase in the number and the size of sovereign wealth funds? They essentially relate to either financial markets or investment policy. On the financial market side, there is much that is reassuring. Sovereign wealth funds are in principle long-term investors that typically do not deviate from their strategic asset allocations in the face of short-term volatility, and they're not highly leveraged. However, sovereign wealth funds can represent large, concentrated, and often not terribly transparent positions in financial markets. Actual shifts, or even rumors of shifts, in sovereign wealth fund asset allocations can cause volatility, and so there are valid issues to consider here. On the investment side, sovereign wealth fund transactions, like other foreign investments, can sometimes raise legitimate national security concerns. In the United States, the Committee on Foreign Investment in the United States, called CFIUS, reviews investment transactions that result in foreign control, it's a very important threshold, of U.S. businesses when those transactions pose genuine national security concerns. Sovereign wealth funds can also raise non-national security-related investment issues related to the larger role of foreign governments and markets. Will capital be allocated efficiently? The U.S. economy is built on the belief that private firms allocate capital more efficiently than governments. How will corporate governance of individual firms be impacted? These questions speak to the importance that sovereign wealth fund investment decisions be commercially driven. So given this set of issues, Treasury has sought to pursue a measured multilateral approach that maintains openness. We strongly support the effort underway in the International Monetary Fund to develop a set of voluntary best practices for sovereign wealth funds by its October annual meeting. In our minds, best practices would do two things. First, they would help create a dynamic of rise to the top in such areas as institutional arrangements, risk management, and transparency. And this is very much in everyone's interest. But they would also help visibly demonstrate to critics that sovereign wealth funds have been and can continue to be positive, constructive participants in the international financial system. Maintaining openness, though, is a two-way street. Recipient countries of sovereign wealth fund investments also have an interest in presenting sovereign wealth funds with an open, predictable, and transparent inward investment regime. That's why the United States has proposed that the Organization for Economic Cooperation and Development, which has a long history in promoting open investment, identify best practices for recipient countries. And the OECD has actually just published an initial paper on these issues. Finally, Treasury is speaking to sovereign wealth funds directly. The CIC has had its share of visitors. Most recently, on March 20th, Secretary Paulson reached agreement with Singapore and Abu Dhabi, two of the largest and oldest sovereign wealth funds. Each of them has been around for roughly a quarter century, on a set of policy principles for sovereign wealth funds and countries receiving sovereign wealth fund investment. These principles are intended to support the ongoing processes in the IMF and the OECD to develop best practices. So, to wrap up, sovereign wealth funds have been around a long time. They're here to stay. There are fears about sovereign wealth funds, but many of those fears are exaggerated. Naturally, it is important that Treasury and the U.S. government remain vigilant and address the legitimate issues that are raised by sovereign wealth funds. But the U.S. is committed to doing so in a way that keeps our doors open to foreign investment, including from sovereign wealth funds.